In the summer of 2001, a company worth more than McDonald's, AT&T, and General Motors collapsed in just 24 days. Not because of a recession, not because competitors beat them, not because their product stopped working, because of one accounting trick, one line item, one decision to treat expenses as investments. The company was Enron. And before you think this is just another corporate scandal story, understand this: the accounting method that destroyed them is still legal, it's still widely used, and it's hiding in plain sight across dozens of industries right now. Let's rewind. December 1999. Enron is the seventh largest company in America. Its stock is trading at $80 per share. Fortune magazine names it America's most innovative company for the fifth year in a row. Wall Street analysts have 16 buy ratings and 0 sell ratings. The CEO, Jeff Skilling, is on the cover of magazines. He's giving TED-style talks about the future of energy markets. He's recruiting from Harvard Business School like it's the NFL draft. And deep inside Enron's finance department, a small team is doing something very clever with their accounting books. They're using something called mark-to-market accounting. Now, here's what that means in plain English. Normally, when a company signs a deal to deliver natural gas over 20 years, they record revenue as they deliver the gas. Year 1, you record year 1's revenue. Year 10, you record year 10's revenue. Boring, slow, accurate. But mark-to-market accounting says if you sign a 20-year deal today, you can estimate the total profit from that deal and record it immediately. All of it, right now, even though you haven't delivered a single cubic foot of gas. You're marking the value of a future contract to its current market value, hence the name. On paper, this seems logical. If you sign a $100 million contract, that contract has value today. It's an asset. Why not recognize it? Here's why not. That $100 million, it's a guess. It's based on assumptions about future gas prices, inflation rates, delivery costs, and whether the other party will actually pay you for 20 years. You're estimating profits from deals that haven't happened yet, based on models that might be completely wrong. And here's the uncomfortable part. Enron wasn't just using this for energy contracts. They were using it for everything. Broadband deals, water projects, partnerships with Blockbuster to deliver movies on demand. They'd sign a speculative deal, run it through their financial models, and boom, instant revenue, instant profit. The stock goes up, bonuses get paid, analysts stay happy. But the cash, the actual money, that was supposed to come later, much later. Let's talk about what was actually happening inside Enron. By 2000, Enron is no longer just an energy company. It's a trading company, a finance company, a tech company somehow. They're trading electricity, natural gas, bandwidth, weather derivatives, and even emissions credits. Jeff Skilling has a vision. He wants Enron to be the Amazon of energy, a digital marketplace where anything can be bought and sold, electrons, data, risk itself. And Wall Street loves it. But here's the problem. Most of these new businesses aren't making money. The broadband division is burning cash. The water projects are slow. The international deals are complicated, and some are outright disasters. And yet, every quarter, Enron reports growing revenue, growing profits. The stock keeps climbing. How? Mark-to-market accounting. Here's an example. In 2000, Enron signs a 20-year deal with Blockbuster to create an on-demand video service. This is pre-Netflix, pre-streaming. The technology barely works. The market doesn't exist yet. But Enron's finance team models out the deal. They estimate it'll generate $111 million in profit over 20 years, so they immediately book $53 million in revenue. for a product that doesn't work, sold to customers who don't exist yet, based on a technology that won't be viable for another decade. The deal falls apart 8 months later, but by then, the revenue is already on the books, the stock has already moved, the bonuses have already been paid. And here's where it gets darker. Enron starts creating off-balance sheet entities, special purpose entities, partnerships with names like Chuco, Jedi, and Raptor. The purpose? To hide debt, to inflate profits, to create the appearance of success while reality is crumbling beneath them. They sell assets to these entities at inflated prices, booking immediate gains. They move debt off their balance sheet so analysts don't see it. They use Enron stock as collateral for loans, creating a circular system where the stock price itself is holding up the house of cards. CFO Andrew Fastow is running some of these partnerships personally. He's making millions on side deals while working for Enron. It's a staggering conflict of interest that somehow flies under the radar for years. And the auditors? Arthur Andersen, one of the big 5 accounting firms, is signing off on all of it. They're collecting $52 million a year from Enron, $25 million for auditing, $27 million for consulting services. They have every incentive to keep Enron happy, and they do. Now let's zoom out for a second. This isn't just about Enron being corrupt. That's too simple. This is about a system that rewarded appearance over reality, quarterly earnings over long-term health, stock price over cash flow. Mark-to-market accounting gave Enron a legal way to fabricate success, and the incentive structure made it almost impossible not to use it. Think about it from Skilling's perspective. You're CEO. Your compensation is tied to the stock price. Analysts are expecting 15% growth every quarter. Your competitors are using aggressive accounting. Your board is asking why you're not moving faster. You can either A, use conservative accounting, report lower earnings, watch your stock price stagnate and get fired, or B, use mark-to-market, report higher earnings, watch your stock soar, get rich, and worry about the future later. What would you do? This is the uncomfortable truth about financial incentives. They don't just encourage bad behavior, they make bad behavior feel rational, even necessary. By early 2001, cracks are starting to show. A reporter named Bethany McLean publishes an article in Fortune asking a simple question: how exactly does Enron make its money? She's read the financial statements, she's talked to analysts, and nobody can give her a straight answer. Enron's business model has become so complex, so opaque, that even Wall Street experts don't understand it. The company is trading at 55 times earnings, far higher than any energy company should be, and it's not clear why. Jeff Skilling calls her. He's bangry. He calls her questions unethical, but he doesn't answer them. Then, in August 2001, Skilling abruptly resigns. He says it's for personal reasons, but insiders know something is wrong. The new CEO, Ken Lay, tries to reassure everyone. Our performance has never been stronger, he says in a company-wide email. We are hitting on all cylinders. He's selling his own stock as he writes this. October 16, 2001, Enron announces a $638 million loss and a $1.2 billion reduction in shareholder equity. The off-balance sheet partnerships are unraveling. The stock drops 20% in one day. October 22nd, the SEC opens an investigation. October 27th, Enron starts buying back its own stock to prop up the price. It doesn't work. November 8th, Dynegy, a smaller energy company, was going to buy Enron for $8 billion. They walk away. The deal is dead. December 2nd, 2001, Enron files for bankruptcy. At the time, it's the largest bankruptcy in American history. 20,000 employees lose their jobs. Many lose their retirement savings, which were heavily invested in Enron stock. Shareholders lose $74 billion in value. Arthur Andersen, the accounting firm that enabled all of this, is indicted for obstruction of justice. They're convicted. The firm collapses. 85,000 people lose their jobs. Jeff Skilling is eventually sentenced to 24 years in prison. CFO Andrew Fastow gets 6 years. Ken Lay is convicted, but dies before sentencing. And mark-to-market accounting? It's still legal. It's still used. Banks use it. Investment firms use it. Anytime you hear about fair value accounting, that's a descendant of the same idea. So what's the lesson here? It's not that accounting rules are bad. It's not that all companies are corrupt. It's that when you create a system that rewards short-term appearances over